Investing is an expectations game, and today's guest wants to help you get the probabilities in your favour. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce with my co-host Ren, and today we're talking about the changing global markets as the US falls and Europe and China have a moment, and how we can all think about positioning our portfolios. Ren, good to be with you.
Bryce, good to be here. Excited for this episode. We're going to be joined by Matt Wacher, who's the Chief Investment Officer of Morningstar Asia Pacific. And as you said, we're seeing the shifting sands in global markets.
Big time.
We've seen the US and Australia have a tough start to the year. Europe, the UK, Hong Kong are all up double digits. It is a different market to, I guess, what we've really been used to for the past decade. And Matt is someone who is really focused on what share prices are telling us about expectations for markets and for stocks, and really trying to find those opportunities where expectations are too low and the fundamentals of companies don't have to do much to jump over those expectations. Yes. I think we can say. Yeah.
Now, before we get into it, a huge thank you goes to our launch partners for Basis Points, Milford, Orbis Investments, and SIBO. Without their support, we wouldn't be able to keep this content free and accessible to all of you. A reminder as well that this content and plenty of the other episodes that have been launched are available for CPD points. They've been accredited by the FAAA. There'll be a link in the show notes for you to go and get that accreditation.
Now, if you're loving the content we're doing here on Basis Points, a reminder that it doesn't stop with this show. We have an email that you can sign up to. Link is in the show notes. And if you want to join the conversation after an episode drops, come over and join the conversation on LinkedIn. But Bryce, with that said, let's get to our conversation with Matt.
Well, Matt, welcome to Basis Points.
Thanks so much for having me.
Now, we want to start by unpacking the concept or the idea that investing is really an expectations game. Stock prices and overall market levels can really give us an indication of how investors are thinking and what they expect to come next. So as you look out over global stock markets today, how do you think investors are thinking as we sort of get set into 2025?
Well, it's a little bit muddled at the moment. I think the last couple of months have probably, the thesis that maybe the US lags a little bit and global markets catch up, that's kind of started to play out. And expectations for kind of global equities, I'm speaking in generalities here, were probably very low. For US equities, much higher expectations built in. They thought that, the Nvidias, the Magnificent Sevens are going to just continue to deliver and smash expectations out of the park. Those consensus beats that they were having over the last few years. All those big tech companies, they think that was going to go on forever and priced into perpetuity. Now that generally doesn't play out, and expectations peter out or change. And we think, generally speaking, investing in stuff where the expectations are really low is, from the market, that is an interesting place to invest because the bar's much lower. Where in US equities, for example, over the last couple of years, where expectations have been very high, a lot has to go right for it to continue on, and that could happen. But on the we're probabilistic investors, and on the balance of probabilities, it generally doesn't work out. Doesn't mean that they're not going to continue to go up, but catch up will come.
We want to dig into some different markets and sort of where the expectations are. And let's start here at home in Australia. And I think there is no more lofty expectations than some of the Australia's big banks. Commonwealth Bank priced for perfection, some may say. And we've just come through reporting season here, and some of the bank's earnings didn't really seem to back up the valuations that they're trading at, and I guess the expectations you can read into those valuations. So how do you think about the banks? And I guess, what do you attribute these continuing high expectations to?
Maybe I'll start with kind of just the general, and then I can talk CBA specifically, and maybe just maybe some hypotheticals of why these banks seem to be levitating above where everyone thinks they should be. But I mean, generally, Credit growth, it's one of the main drivers of what the high expectations are. Like people think that, credit growth is going to continue, and investors think it's going to continue for the Aussie banks, backed up by things like, continued population growth, potentially more RBA rate cuts. That's a whole other issue. But people are thinking they're going to come eventually, and so maybe that's going to be good for the banks and continued loan and credit growth. But we see some risks to that. That kind of fairly simple thesis. Obviously rate cuts may not be as smooth as people are expecting. They may not come. They may not. But they may even have to raise rates again. And even if rate cuts come, refinancing market, we saw this a few years ago, could become really crowded again, and you're competing for loan growth and those sorts of things. So it's not a foregone conclusion that actually credit growth is going to continue. And then and that margins are going to be able to be sustained in the banks. And so, expectations, as you say, really lofty expectations out there, and none more so, I guess the worst case scenario, the worst offender out there in terms of overvaluation is CBA, we would say, and I think many other Aussie equity managers would say out there. The kind of a PE of 25 times, 3.5 times price to book, mid-single digit growth baked in there, doesn't look like the greatest opportunity out there. So to your point, maybe that's got ahead of itself, but it seems you've got to assume really the best of all worlds to get to the valuations or get to the price that we're at now for CBA. And less so for the other banks. So maybe you have maybe you get a lower discount rate or something like that. Well, banks are cyclical as well. So why you would think that potentially we have a longer term lower discount rate? That's another question out there. I really can't get to the share price that we're sitting at the moment. So then you have to think, well, return on equity, ROE, continues to improve, and that's kind of what it's got to do, for to service 3.5 times book value. ROE's really got to, return on equity's really got to continue to improve. But again, how are they going to do that? It's difficult, but there's only so many levers you can pull in a bank. And so, we've been kind of thinking, well, why are these, in particular CBA, why is it that it's maybe there's other factors, not non-traditional factors that are helping CBA stay afloat. And so some, the whole rise of passive investing, maybe things like retail investors, they just don't want to sell because capital gains and things like that. So things, we're trying to think outside the box. It doesn't mean that we don't own CBA. In some of our benchmark relative portfolios, you have to own. It's such a large part of the market. But we're certainly underweight.
Yeah, it's an interesting one. The other explanations has certainly come up more and more, and people point to the rise of passive investing, but I think that the bigger elephant in the room is the superannuation funds and now their expectation that they sort of hug the benchmark more.
Yeah.
But then we've seen, like of the top 10 Aussie stocks, a lot of them have fallen, like the banks have fallen and CSL has had periods of underperformance and actually some of the big four banks have underperformed recently. So it's like, is that a satisfactory explanation?
Yeah, I don't think so. And so we're clutching at straws there, trying to come up with a reason. The whole notion of passive investing, as you say, momentum can help a little bit on the way up, but it certainly unwinds on the way down as well. So it's not, that's not the reason why valuations can be constantly sustained at such high levels, because markets will get extended. Trees don't grow to the sky, that kind of concept.
So when you started talking about the banks there, you were explaining how one narrative and one set of expectations around that could justify Aussie banks' lofty valuations is the idea that we'll get more rate cuts and that will lead to an increase in credit growth and that'll be good for the banks. And I just find that narrative so interesting because 2 years ago, I remember the narrative in the media was rising interest rate environments are good for banks because it increases net interest margins and that'll increase their profitability.
Yeah.
So how do we reconcile those two narratives? Is it just that every market environment is good for Aussie big banks?
It seems so. There's lots of stocks out there that the whole concept of and economies as well, where good news is bad news and bad news becomes good news. And vice versa. It seems to me that there's lots of parts of the market that just want to own the banks. There's good reason, I guess, the income that they throw off and those sorts of things. As you say, things change and sentiment changes. CSL's a great example because, the sentiment around CSL 5-6 years ago was could do no wrong, just going to keep compounding and keep delivering. And it hasn't been able to do that. They're even in a stock like CSL or lots of the big tech names, and there's inherent cyclicality. It's not obvious like a bank, but there is inherent cyclicality in all these businesses. We look at, say, some of the big tech names, maybe they're buying too many chips, and then how does that affect the Nvidia or these sorts of things? In the banks, people are just pricing in expectations that things can continue forever, and that is generally doesn't work out. It doesn't mean that markets are going to fall, but we're certainly going to get some sort of rotation at some time.
So Matt, another part of the market that has certainly some lofty expectations, and one you kind of nodded to earlier in the conversation, is the US mega caps. They have sort of had a wobbly start to the year. In fact, they're close to, if not already in a correction across the board.
Yeah.
Do you think the fundamentals of those companies, though, match the expectations?
And the banks as well, the Aussie banks, they're all really good quality companies. They're great companies. And similar with the Magnificent Seven stocks, if we just focus on those. Generally speaking, they're all really good companies. And actually with lots of advisors, any that have heard me speak, I got a bit of watching the Olympics last year. I spoke a lot about the high jump and potentially the pole vault as well, but the high jump. And, the best high jumpers in the world, they get over the bar for a while, but, once the bar gets right up there, occasionally they're going to knock it off. Well, they're always going to knock it off at some stage, but they're not going to get over it at some stage. But doesn't mean they're a really terrible high jumper. It just means that, the bar got too high. And I think that's a really good analogy for some of the Magnificent Seven stocks. They're excellent companies, do fantastic stuff. I mean, I've just put my Apple Watch and my iPhone down. It's probably powered by some sort of chips out there. Everyone's got them all around us. Uses them all around us all day. But that high jump analogy, where expectations have been baked in that we're going to get over the bar every time. We think that's probably where things are at. It's not that we haven't owned those stocks. We certainly have, but now it's starting to get really. And less so after the last couple of, as you say, they're off a little bit. But expectations are still very high for these stocks that, buy the dip, because they're going to continue to deliver. But the bar will get knocked off at some stage. And in terms of our investing, we would rather look to, I'm a short guy. This is a podcast. We'd rather look for the high jump, the bar that I can get over.
Yeah, we need the rest to bring the bar down.
And so that's kind of where we look. But if you think back, and I'm not saying that we're anywhere near .com bubble territory or anything along those lines, but if you think back to some of the Capex that was done back in .com, like amongst some of the telecom providers and things like that, they were building, fiber optic cable that could, sustain a massive amount of data flowing through the cable or those sorts of things. So they overcapitalized there, but then at the same time, for example, the packets of data you could send shrunk as well. So there's things that you can't even foresee. And no one would have at the time when they were building it. They weren't thinking, actually we can send much smaller packets of data. They were just putting, and so this concept of overcapitalization and the capital cycle, potentially we're there a little bit with some of the big tech names and the buying that they've done in terms of chips and others just kind of rushing to take advantage of everything they can get from Nvidia. Maybe all of that will be useful, and the stockpiling that they're doing, maybe they've just overcapitalized a little bit, and we need to be a bit cautious.
And I think the big takeaway from the .com bubble wasn't that these predictions and theses were wrong. It's just that they were early, and
That's
the
right.
amount of fiber optic cable that was built eventually got used.
Yeah.
It was just there was a period where the businesses went bankrupt and
100%.
those assets sold.
Yeah.
And the hard thing about hard things, the book by Ben Horowitz, he was trying to build like cloud computing applications like 20 years before cloud computing became ubiquitous and became the thing that everyone wanted to invest in. And you know, like that could end up being the story here. No one was wrong, but it was just very early.
Yeah.
And that really leads to the company that's in the middle of this infrastructure boom, which is Nvidia.
Yeah.
And in your portfolios at Morningstar, you've been underweight Nvidia for a little while now. So give us a sense of your thinking around the company that is top of everyone's mind.
Nvidia, it really is, to us, that kind of, to simplify, it is really that Capex cycle. So how many more chips do people need to actually buy? Semiconductors have always, they may need to continue to buy. I don't know. But generally speaking, how much more, it's more about their customers. So how many more chips does Microsoft and Amazon and Meta, etc., Alphabet, how much do they all need to buy? And they're really the big players. Obviously, there's smaller players out there that need Nvidia chips as well. And how much more will their shareholders tolerate of this Capex spend as well, I think is the key. So it's a bit circular there in terms of the customer base and Nvidia. And what some of those companies have really done well in the past is, they've been those hyperscalers, and they haven't needed to really rely on Capex to extend their runway, in order to scale those kind of software-y type businesses all of these types of businesses being able to grow without having to spend a lot of money. And now they're spending a lot of money. So there's kind of the angle of, well, how much more Capex will shareholders tolerate? How much more do they actually need before they go, okay, let's put the brakes on here and start to, see what capacity we actually, need to get to your point on some of those, comm services or those communications companies back in the dot-com boom. And then you're going, okay, well, if the expectations for Nvidia are so high that they're going to continue to deliver and not only deliver but smash whatever the expectations were, well, people are going to get disappointed at some stage. I mean, the semiconductor companies, as I've said, they're generally been quite cyclical. It's not to say that Nvidia is not going to... the probabilities are just lower for Nvidia to be able to continue to drive growth. We don't think of Nvidia in isolation. We think, okay, well, are there better opportunities on a risk-reward perspective to be able to invest your money?
Well,
we don't just pick on Nvidia.
Let's turn to where the high jump bar is very low, or has been for a while, which is China, Europe, and the UK. It feels, though, that the expectations there are, well, the markets at least have started the year pretty well. Are you noticing that sentiment and expectations are changing in these markets?
We are, and we have before, and our hopes have been dashed. But certainly, I think expectations are starting to change a little bit, and potentially not for the reasons that we were thinking. I think we've had a China position, a thesis really built, and mainly in China tech. So we're talking the Alibabas, the Tencents, the Baidus, those kind of names. Mainly because we know that they're high quality companies as opposed to some Chinese banks and property companies, less high quality there. So we want to invest in the higher quality names, but that have been really beaten up and expectations are very low or had been very low. And our thesis was really for those companies was built around the consumer. And the growth would come back eventually, and the consumer. Now, the rally that we've seen has been a little bit related to the consumer and growth coming back, but really more just AI and that theme around DeepSeek and the kind of AI theme supplanting itself into China as opposed to the US for a few weeks. So that's not to say our thesis won't play out. We think that it will, and that maybe is the next leg up if you get some more stimulus and those sorts of things in the Chinese economy. But the point being that in China, expectations were very, very low. And so not much had to go right to see, significant moves up from where we were. And it becomes a little bit harder now that we've seen, I think Alibaba's up 60, 70, maybe 75% just in the last 6 weeks. And so that's kind of crazy price appreciation. But it's because, not really much had to go right for that stock to do really well in a short period of time. Sentiment just needed to change a little bit. That bar was very low. As I said, I could get over it.
Well, let's hold on Alibaba, because when we were chatting before, you mentioned that Alibaba was your biggest position in some of your portfolios. And so give us a sense of like when you went into Alibaba, like where the expectations were, like from a valuation standpoint, and sort of what you were reading into the price. Just how low was the bar?
We're always early, so we didn't. We took a small position, maybe even 2022, and felt so. It's been a roller coaster of emotion on that. But certainly once the stock was getting down to kind of, we've invested a few Hong Kong, so I'll talk Hong Kong dollars, 70 Hong Kong dollars, even dipping below that. Between 70 and 80 Hong Kong dollars, we're really starting to add some reasonable size there, and to all the China positions. So when I say it's our biggest position, we run multi-asset portfolios. It's not going to break the bank if it does badly. And also with its position like a China tech stock, there are things that are out of your control from a risk management perspective, so you can't go too big. But it is our biggest position at this point in time. We've held bigger positions in the past, but in other stocks. But Alibaba, when it was down high 60s, low 70s in Hong Kong dollars, but basically people, the buybacks that it could do were going to outweigh. It could have basically almost taken itself private and been a fantastic buy at those times. And so we was adding to our positions quite substantially there, and we just thought that no one wanted to own China. And potentially lots of investors still think China's uninvestable, but we think that you got to just play what's in front of you at the time. You can't. Everyone needs to invest, and if we're weighing it up to have a position in, say, Amazon which is quite expensive still at this point in time, versus Alibaba, we think well, maybe a small position in Alibaba is going to give us the alpha for our portfolios, taking into account the risks versus going into something where maybe the valuations are high and you get the reverse of what we saw in Alibaba. You get potentially air pockets to the downside. Yeah.
Well, I'm looking in US dollars here, but it's up 75% since its lows. This year, and it's now just trading on 20 times earnings.
Exactly.
So at one stage it would have been on 12 or 13 times earnings.
Or even high single digits.
Yeah.
Our thesis hasn't actually played out. It's been a change of sentiment.
And
that's you see that. That's market.
The
expectations have just changed.
Now, Matt, we want to now talk about getting the probabilities in your favour when it comes to investing and knowing how to understand expectations. Given that expectations drive short-term movements, how should we as investors navigate that?
That's the key question for any investor, whether you're a growth investor, a value investor, core, whatever you want to call it. Understanding, what's priced into the market, what you think fair value is, and where the price is now relative to that. That's kind of the key, because you want to be able to take advantage of others. Behavioral biases is the way I'll say it. Some people are going to think that Nvidia's going to continue to deliver in perpetuity. Some people are thinking that China's uninvestable. And so people, the way we like to invest is to be a liquidity provider. We like to sell some of our Nvidia stock if it gets too high and buy some Alibaba stock, if it gets too low. Simplification, but that's kind of the way we think about it. In terms of, I guess, the way that we think about investing and expectations is the key thing to know is what's implied in the price. And so how many chips does Nvidia need to sell? Like, we probably don't go down to that level, but how many chips does Nvidia need to actually sell? What's the likelihood of that? What does that mean? How many iPhones does Apple need to sell? How many AirPods? Or does it need to sell to sustain the share price, and what kind of growth does it need to be able to deliver on that? They're all things that we would look at when we're looking at the price of stocks that we might want to own or that are in our portfolios. We'll also look at it from more aggregate level, like sectors. As I say, we're multi-asset investors, so we can't spend too much time all just not understanding every stock out there. We might go, okay, well, we think the UK is a better valuation opportunity at this point in time versus the US, because the expectations for the UK are lower versus the US and those sorts of things. But to understand, okay, well, how do the market's expectations relate to what we want to invest in? We've got to have a really good handle on what we think fair value is and what we think the price of an asset is as well. And what we've done in the way we invest is look over the ultra long term. Generally, assets revert to their fair value or revert to the mean. We're not necessarily pure value investors. We'll price up or calculate the fair value on a tech stock differently to an energy stock. It's not just go price to book really low, let's invest in that. But what we want to understand is, well, over the ultra long term, markets are going to generally, fundamentals are going to matter. The cash flows of the underlying businesses are going to really matter. Valuation is going to matter very little over the ultra long term. But in the short term, valuation and the market dynamics matter a lot.
I want to drill down on that, because it is, I think every early investor, every early advisor gets this quote drilled into them, that in the short term the market is a voting machine, in the long term it's a weighing machine. Benjamin Graham. And it's an interesting interplay, because on one hand, in the short term, expectations drive movement. And so it's like, okay, we'll find where the bar is low, because if they can clear a low bar, then you can see some upside there. But then in the long term, you want to be in high quality stocks that are growing their earnings. And that often is companies where the bar is a little bit higher. So how do you think about positioning your portfolio for the short term, but also making sure you're in the high quality long term assets?
We have a framework for investing, investment process. We want to make sure that we stick to the process, and I think that's hopefully good advice for anyone. If you've got to work out what you're comfortable investing, how you're comfortable investing, and stick to the process. But part of our process is acknowledging what you were just talking about. As I was saying, a tech stock is going to have potentially more asset light, not as need to do as much capex, not need as many assets to survive, and to deliver really much higher growth than, say, an energy company, where they've got to go and dig a well and deal with all the cyclicality that goes with that. And so the way that we calculate fair value, or that we look at the fair value of an asset, the tech company is probably going to have a much higher ROE than an energy company. And so it's really getting down into the weeds of the stock or the stocks or sectors themselves, and going, okay, well, this company not necessarily should be penalised, but maybe a tech company needs to, we can afford to give it a higher growth rate because we know that they're better growers, and have a process, but not being so dogmatic that okay, well, if you're a value investor, only invest in, as I was saying, kind of, stuff that's super cheap.
Yeah.
You need to have that understanding that actually there is a quality component to it. Maybe there's an asset that's so cheap that and such terrible quality, it's garbage, but it's so cheap that you can invest in it. You can get comfortable with that. But generally, having that quality filter, being able to look at assets in different ways, price up fair value in different ways, means that you're going to capture some of that quality.
So if I can maybe torture this analogy too much, it's a two-step process. First of all, figure out how high the bar is, and then secondly, find out how high your company can jump.
That's right.
And you want to find the highest clearance.
The highest. That's probably a really good way to think about it. The highest probability of clearing that bar is the way to think about it. So when the high jump bar, I don't even know what the world record is. When it's at the world record, the probability of clearance is low. at the start of the high jump,
yeah. Well, for me, it's like the Nvidia example. I know we've used it a few times today, but it's a classic example of that. They report 145% increase in profit and 114% increase in revenue year on year, and the stock falls. Like, that is a world record, a jump attempt there.
Yeah, that's right. That's right. 100%.
Yeah.
It's and the reason is because markets are forward looking.
Yeah. So we asked if you could bring a stock to the table to close out this conversation that sort of illustrates what we've been speaking about here: low expectations, ability to clear the bar. So is there a particular stock you've bought today?
There is, and I guess the US market, everyone's talking about how overpriced it is, or that's been the kind of theme over the last kind of 6 months or so. But I brought a US name, and it's Nike. I'm a runner.
Okay.
So, it's a stock that we've been looking at and put in the portfolio just at a small weight, and we'll probably continue to add to it in some of our portfolios. But the market is really presumed, or it seems the market's really presumed that Nike's going to struggle this year. It struggled a bit last year, and their main concerns are the potential reignition of inflationary pressures. That's eroding discretionary spending, except for runners like me who will just continue to buy running shoes no matter what. Obviously China, again, the consumer in China still being weak, and that's due to there's obviously the macro conditions, but also increased competition for a company like Nike as well in China, and globally, and also the lack of kind of new products, I guess, is one of the other reasons the market is thinking that maybe Nike's going to struggle. And we really think that that's a little bit short-sighted. The current cycle, the current downturn for Nike, it's been pretty painful, and consumers, you see it everywhere. Consumers have been a little bit weak. Consumer confidence in the US came out recently down a bit, but in Australia, as another example, obviously we spoke about China. Australia, consumer confidence has been fairly weak. Retail sales until recently have also been pretty weak. That's cyclical. We think that interest rate cuts and those sorts of things, even if many interest rate cuts don't come, the psyche of the consumer, it changes. I think the key risk around it is probably that if inflation does come back and the consumer really tries to pull back, that's probably a risk globally for Nike. But we believe that Nike's margins, they'll recover. As they're doing a lot of cost cutting. There's probably a lot of fat in the business that they can carve out. Not dissimilar to what the Metas and Alphabets, maybe not to the same extreme, but back in end of 2022, they could suddenly just cut out a lot of fat out of the budget, which they did, and we think Nike can really do that. And we think that they gradually shift back from kind of the discounting cycle that they've been in with lots of their products to, being able to sell, their really pretty high quality products in the long run. Pardon the pun.
It certainly feels like that the narrative for Nike is changing a little bit. It's that it's that turnaround story. They've brought in a new CEO, and the market is starting to not necessarily be, I guess, put in a positive light, but it feels like it could be bottoming in some way. What are your expectations for it going forward? Like, where are you setting the bar?
The way we think about it is a relative game. We think that the growth, consumer spending, all these sorts of things will come back. That's kind of the thesis here. We think that China will they will stimulate the economy again, that China will come back and they'll be wanting to grow. Or consumers will be wanting to spend on the back of that growth. And that what we're going to see there is that yes, sentiment for Nike will then turn around and that story will continue along with the change of CEO and cost cuts. Where that's going to get to, we don't know. We'll probably be out before it will be out too early as we get into it. But yeah, I think that and relative to other parts of the market, we think that it's an interesting one to gain a little bit of US exposure, but the bar's not too high.
Yeah, definitely.
Nike for me is an interesting one because there's like two parallel stories going on, and I think you've touched on the macro story around like the weak consumer and stuff like that. But then there's also like a company specific story playing out because like Nike executed really poorly for a while there. They in some ways the running company missed the running boom and they lost market share to, you know, the Hockers and the Brooks of the world. But then also the story that emerged in that post-COVID world is they really tried to go hard on direct to consumer and they hurt a lot of their wholesale relationships, and that was a big reason why the CEO left, and they got a new CEO and they're trying to mend those fences. How do you think about that idiosyncratic company risk side of it, and like how are you assessing their ability to execute on and correct those two mistakes?
We think about it in terms of sectors and themes more. So we're going to look at the idiosyncratic issues with Nike. We'll talk to our Morningstar equity research team around that, and certainly they raise a lot of these issues. But in a positive way, they think that they can turn those around. They think that Nike's done it before; it's in their DNA, and that lots of these idiosyncratic missteps, they can overcome them. They're going to need to cut some costs, redirect growth, and those sorts of things. But these are things that they can deal with. The way that we think about it is, and Nike's just one example, is probably, well, the consumer seems to have been pretty beaten up over the last few years. You know, China is a key driver of that. But also in Europe and the US and Australia. Like, people haven't just been getting out there and spending crazily. We've seen, retail sales generally been quite subdued globally. But the markets have done well in spite of that. And it's really that those, been driven by the mega caps and those sorts of things. So the Magnificent Seven or the banks that we've already spoken about today in Australia. And so we see that whole theme of the beaten up consumer discretionary type stocks. Nike is a kind of poster child of them, but there's many others out there as well. Burberry is another one that we're looking at, LVHM and these sorts of things. So, really high quality companies that have the potential to do really well, but that just have had the baby thrown out with the bathwater, and rightly so in some respects. But we think that they can turn them around. Yeah,
that luxury story is one that we haven't spoken about, but that certainly seems another one where the bar is quite low at the moment. Yeah. LVMH, Caring, all of them. Yeah.
And it's all on the back of that consumer discretionary kind of, the story that, okay, well, why would you want to own these when the macro growth doesn't seem to be there?
Yeah. Well, Matt, that brings us to an end today. Thank you for joining us. We really appreciate it. We'll be certainly looking for very low bars and finding ways that we can step over them.
Exactly. I have to come up with a new analogy, but until the next Olympics roll around. So I've got a few.
Yeah, true. Well, thank you for joining us today.
Thanks a lot, guys. Thanks for having me.